Hello everyone, it's Irfanali Moladina with RMI Professional Corporation. Thank you for joining us today. We're going to give it a couple minutes to let some people come in, but today is our quarterly one-on-one session, and I'm very excited to say that our topic for this quarter is around estates and estate planning, succession planning. But as always, if you have any questions on any topic, I'm here and happy to answer anything. So we'll give it another minute or two, let a couple more people join in, and we've had some questions come in from earlier, and then of course ask away throughout the day, throughout the session as well. Once again, it's Irfanali Moladina, managing partner of RMI Professional Corporation, and so we'll get started. So the first question I've got given here is, an individual has a holding company, 100% owned by that person, and they own an operating company at 51%. So the question is, if they are the first partner in the opco to die, there's a shareholders agreement that says the holdco ownership of opco reverts to 49%. There's no will in place and know nothing about the process. I'd be hoping to transfer ownership of holdco upon death to my wife. Does a personal will cover that adequately, or is there something else I should be looking at doing? Anything else I should think about? So great question. And so what we'll see a lot of times is when somebody passes away, there is a tax-free rollover that you can do to your spouse. So in this case, if you were to pass away, we can transfer the shares from yourself to your spouse, tax-free, no issues. If the spouse was to pass away and it goes to the children, then what happens is there's a deemed disposition of all your assets, including shares of the company. So if both of you were to pass away, or you pass away and then the wife passes away after, when she passes away, what has to happen is there will be a valuation done on the corporation. We have to figure out the growth of that value of your shares. Once we figure out the growth, then that goes on to your final estate tax return, and the taxes need to be paid to complete the transfer of your property to the next generation, children, or any other party that you choose to do. So a will does adequately cover it in this scenario, and a will is always good to have in place. I know you mentioned you don't have one, so it'd be really good to get a will in place because it does streamline that process of transferring your assets over. So great, that leads to the next question. Why is it important to have a will? So what happens is, without a will, your estate can be contested very easily. When you have a will in place, it lays out, and usually your executor would have a copy. It lays out exactly the way you want things to transfer over. So it tends to save you a ton in legal costs and probate costs in terms of potential fighting, and not so much you, but it does save your estate or your family that extra cost. So having a will, very easy to get done. Lots of lawyers can do it. We can connect you with some if you need assistance in that space, but highly recommend getting one in place. Makes the whole process once you pass away a lot easier for your estate. I got another question here about underused housing tax. So temporary resident in Canada, do you need to worry about that? Great question. So as long as you're a resident in Canada, right now there are avenues where you would be considered exempt, but it's good to look at your situation as a whole. So great to dig into it a bit deeper, but typically the way they've managed to do it is if you are a PR here, if you're a resident of Canada, and you're inside of a property, you're okay. If you are here on work permit, if you are here, if you're a business that owns property, or anything in that situation, you'd want to look at your situation a bit closer to see if you do actually need to file. You most likely wouldn't be subject to the taxes, but there's a chance that you would be required to still file. If I leave all of my belongings to my spouse when I pass away, are there implications, tax implications upon death? So again, most things upon passing, there is something called a tax-free spousal rollover that you can implement. And so on that tax-free spousal rollover, what happens is your estate can go to your spouse and nobody's getting dinged with any taxes. It's when you want to pass it to a third party, when you want to pass it to children or the next generation, then what happens is your estate would have to take a value of the properties. That could be potential capital gains or different things like that. And then what would happen is you would end up with some taxes at that time. Once again, it's Irfan Moladina, managing partner of RMI Professional Corporation. Here, doing our one-on-one quarterly session here. If you have any questions, feel free to write them. We're focusing around estate planning and succession planning, but as always, if you've got questions around any topic, happy to answer. What happens to my RSPs when I die? So, good question here as well. Basically, the RSPs become taxable to you at that time. So if you're sitting on $500,000, your estate takes that as income. The tax bill is there, needs to pay out the bill, and the remaining cash can go according to your will and the estate in itself. So it's really good to plan out how you want to really utilize your RSPs while you're alive. If you're leaving a big chunk in there, you can be subject to quite a high tax rate on them when you pass away. How important is succession planning? So the straight up answer is very important, and I'll explain a bit more why. So a good example, let's say I'm a business owner and I'm running a great business and it's worth $1 million and I pass away. If I have nothing in place, then what would happen at that point is that $1 million goes as a capital gain on my tax return, and my estate is subject to taxes on that $1 million valuation. So if my big kids or my children or anybody wants to take that over, then what would happen is the state needs to pay the taxes in order to complete the transfer of the property. So if you're now on the flip side, if you do some succession planning, and let's say we want to take that same business and pass it to my kids, then what I can do is I can maintain control in some instances of my company, but I can start to transfer that value out over time. So when I pass away, there's very little value left attributable to my name, and my kids can take over the property or the company. The same scenario can apply with property, for example, right? If you have a property, it has a really big capital gain, maybe you've owned it for 20, 30 years, it could be a family cabin, it could be anything. And when you pass away, if you haven't done the pre-planning around this, again, the estate can be subject to quite a bit of tax in order for you to, and that's quite a bit of tax in order for that transfer of property to occur. Meanwhile, if you've done the advanced planning, if you've done some of the succession planning, the property could have already been transferred while you're alive, or you can have the proper insurances in place to cover off any possible tax debt. There's a lot of different avenues to make sure things can go a lot smoother versus putting your family in a bind where they need to come up with hundreds of thousands or millions of dollars to pay off a tax bill because we didn't do any planning in advance. So great question there. Next question, may I still claim first-time homebuyer credit if I sold my previous principal residence? So the answer on that one would be no, because it is a first-time homebuyer's credit. So you can use it on on your first property, but if you have multiple properties or you're buying a second property, then unfortunately it doesn't qualify for you there. What happens if an individual passes away without a will? Great question. So when somebody passes away and there's no will in place, typical process around that is the estate goes to probate, and in probate it can get challenged. And it can get challenged by people who say they may have a claim. They still have to justify it in some ways, of course, but it essentially, the property sits with the government and it gets challenged until there's a resolution. Once it's resolved, then the property can pass over accordingly. So you can see how it can become a very dangerous situation, and the family could lose control. You might have an old partner or old spouse or whatever the case is pop out of the woodworks and say, well, I was promised this much money, and now they're fighting over a portion of your estate. As you can imagine, it can get really messy, and it can get very expensive. And so what tends to happen a lot of times is a big portion of the estate tends to get whittled away in professional fees, and there's very little that gets transferred over to the family after compared to the size of the estate. Is it a good idea to have a business-owned life insurance policy? So you'll hear this answer quite a bit in every session, and that is it depends. And so in this case, a business-owned life insurance policy can actually work out very beneficial. A good example is people might have heard of keyman insurance. So you're the owner of a business, you get keyman insurance, the business is the beneficiary. What happens in this instant is if you were to pass away, the company gets access to this big life insurance policy. But what's really neat about that policy is it usually creates something we call CDA, or a capital dividend account, and that CDA can be paid out tax-free to the shareholders. And so what's really neat about this scenario is take it where you have two partners in a business. Both of them have this keyman insurance. It's a life insurance policy owned by the company, and one of them passes away. Well, they might have a shareholders agreement that says the other partner has to buy them out. And so the other partner says, okay, I have to buy this partner out, but I don't have the cash for it. Well, when you have this keyman insurance, the company gets given all this cash, and it can be taken out of the company tax-free, so that can be used to pay out a shareholder, for example. So there's lots of different avenues that can be very beneficial. Same thing on a whole life policy. You can use corporate dollars to buy the policy. It might not be tax deductible depending on the scenario again, but if it's not tax deductible for the company, the thing to remember is you can still use corporate dollars to pay for it. And that's pretty big because our small business tax rates are only 11%. And if you compare that to our average personal tax rates, they end up in 30 to 40%, up to, in Alberta, it's 48 is your highest rate. So you can see there's a big advantage by being able to use corporate dollars to buy an insurance policy. Sorry, I'll catch up here on some of the questions. These are great questions coming up. Can I give my house to my kids while I'm still alive? You can. If it's the house that you're living in, for example, we need to be able to, we can dispose of it as a principal residence for you, and you can pass it on to your kids. Sometimes you might not want to, because on death, your principal residence is also tax-free to the estate. So what happens is if you're still living there, you can say, you know what, I'm going to keep my principal residence till the day I die, but I'm going to put my son or my daughter on title, so it makes the transfer to them a lot easier. And something like that is very possible for sure, and without any taxes. Another question, if I sold my rental property, may I claim as sold as principal residence if I didn't claim any CCA before? Well, if it's a rental property, you got to be careful. Typically, rental property does have, you are subject to capital gains tax on that. So there are certain scenarios you may be able to claim a portion of it if you lived in it for a certain period of time, or different things like that. So that one you'd want to look at your specific situation and reach out and talk to us, and we can for sure help out on that end. But most likely, if you've got a rental property, you'd have a capital gain on that property instead of being able to claim your principal residence exemption there. One thing that's very interesting is on the principal residence side, there's new rules that came out last year that says that you do need to live in your property for over 1 year or longer to deem it as a principal residence. So a lot of people are moving every 6 months. So some of that stuff, it's always good to keep in mind too. Back to some more questions here. So next one is, how does a trust work? So great question there. So I'm guessing you're talking about a family trust. There's a couple different types of trusts that can get created, but if we're talking a family trust, what's really unique about these scenarios is a family trust is like another entity. So you'll hear about corporations. Us as individuals are all considered a separate person for taxation. The corporation's another entity, and a trust is now another entity as well. And what happens with these is there is a settler who is responsible for setting up the trust. Sometimes it might be a grandparent or something like that. Once they set up the trust, they will put trustees. Trustees are there to oversee and run the trust, So a lot of times that might be the person who's setting up the family trust, who has the assets going in, different things like that. And then the third term to keep in mind is a beneficiary. So a beneficiary is somebody who's entitled to something from the trust. So that a lot of times could be the whole family. And the way they work is income earned by the trust. So the trust might own your corporation, for example, and then the corporation makes money. It can pay a dividend. That dividend can then be distributed to any of the beneficiaries based on the trustee's decision. So you can see it does allow for a bit more flexibility. Long-term growth and investments can be attributable to more family members. The big thing that a lot of people still try to use a trust for is the capital gains exemption. So if you sell the shares of a corporation, each individual is entitled to a tax-free portion, and that tax-free portion can get multiplied by all the beneficiaries. So it is a great structure. A lot of people have it. A lot of people can use it, and there's lots of advantages to it. But before going down that path, I would always recommend come in, chat with us. Let's see if that scenario actually makes sense or not for you. What details and specifics would be included in the succession plan? Ooh, great question there. So I would say each succession plan is catered to the individual and the family. But the big things to really consider is having a will. Beyond a will, it would be a will, a personal directive, we call it, or some people say it's like a living will, where you're giving somebody the authority to make the decision of what medical needs and things like that you need, if you are unable to make those decisions for yourself. Then there's another item called a power of attorney. That again is while you're alive, you're giving somebody the ability to act on your behalf, to make financial decisions with you. So those are the three main things that anybody getting doing some succession planning, those are the three things you should get in place right away. And then beyond that, you would want to look at what you have in your current estate. What assets do you have? What liabilities do you have? What bank accounts do you have? And then you want to start planning out and saying, what do I want to do with these assets? Am I transferring them to my kids? Am I giving it to charity? And once you start to build all of that around it, then you can go and accomplish those documents where you can put a will in place, or maybe we need to do some restructuring and get a family trust in place. And then there may be other stuff that pops up depending on each individual's needs. Can I deduct funeral expenses on my grandfather's final return? Great question there. There are certain expenses that can be deductible. I'm not sure of all of them off the top of my head, but I will for sure get back to you on that one. There are specific things that can be deducted, not all of the funeral expenses, of course, but there are elements of expenses upon somebody's passing that can be claimed, which is always nice on that end there. So once again, it's Irfanali Moladina with RMI Professional Corporation. Thank you guys for joining today. Happy to answer any questions. Our topic for the quarter is around succession planning and estate planning, but as always, any questions, feel free to throw them out there. How does an estate freeze work? Great question there too. So what happens in an estate freeze is you might have a corporation, and a very common thing is, I've created a corporation, I've grown it over the years, it's now doing great, but I'm saying, okay, I want to add in other shareholders. I want to bring my kids in as a shareholder. And different scenarios like that, what happens is we got to freeze the value of the corporation. And so let's say the value at the time is $1 million. We freeze the value at $1 million, and we say, okay, that $1 million is attributable to the existing shareholders, okay? And there's mechanisms to be able to defer taxes on that, and that's part of what we use an estate freeze for. But then what happens is once we've been able to allocate that income, we can then go in and bring in other shareholders. We can go and restructure, we can add in a trust, or we can do different things like that. But it's really important, the estate freeze in itself is the first element for us to be able to actually go and do any type of restructuring. So a common thing is we would freeze the value. If it's $1 million, we would issue what we call preferred shares to the existing shareholders. The preferred shares would need to be paid out or redeemed over time, and then we can essentially go and change the share structure that we want to do. So it does get more complex on the tax side for sure, but it's a very, very useful tool should you want to do any further succession planning and estate planning. How early should I start with estate planning? Great question there as well. It never hurts to start early, that's for sure. So I would say the minimum requirement is if you have kids, if you have a business that's growing and you want to make sure you can control what you're doing with it, you should start the planning around it from day one. It's always something that is important to keep in mind, and it's a question that a lot of our clients would be familiar with. But I'll ask you, what's the plan with your business? Where do you want to go? Are we growing this and selling it off in a couple of years? Are we going to do some restructuring? Do we want to leave it to our kids? So I'd say it's never hurts. I'm still fairly young, but I've already started my estate planning. So it's never a bad thing to start it, whether you're in your late 20s, early 30s. Once you start to build up and you've got some corporations and you've got some assets, you want to have the estate plan figured out, because you want to make sure, you never know what happens, right? And you want to make sure that your wishes can be carried forward to your estate. What documents do I need as part of my estate planning? So yeah, similar on the succession planning side, they're very interchangeable, I'd say. So the big things, like a lawyer can assist you with your will, your personal directive, your power of attorney, and then on the accounting side, it's more of an individual basis, because it depends what assets do you have, what are you going to do with those assets, and how are we going to transfer that over. But key things to keep in mind too during this process of estate planning is, the number one thing is, what do you want to do? What do you want to do with your assets? What do you want to do with your property? Are you going to leave it to family? Are you going to leave it to your kids? Are you going to leave it to charity? What do you want to happen with that property? And then secondly is, who are you going to put to carry forward that? Are you going to hire a company to do some to handle your estate at the end? There's obviously fees with that. Are you going to assign one of your kids or your spouse to manage the estate and be the executor? Are you going to bring in somebody else, right? So it's really important to figure those pieces out. And then beyond that, I had mentioned two other documents, being the personal directive and the power of attorney. So the personal directive is, who are you entrusting to make medical decisions on your behalf? If you're in a coma and they need to be the one to decide, do we pull the plug and let that person pass away, or do we try to resuscitate them? You want somebody you can trust to obviously make that decision. And the last one's the power of attorney. And the power of attorney is, if you're in that coma, who is the one who's in charge to go and handle your affairs? Who's going to pay your bills? Who's going to be able to access your money? Who's going to be able to take control over those kinds of things? So very important to really start thinking not only from your assets and what you have, but who are the people that you're going to leave in trust of handling your affairs when you're gone or when you're unable to. What happens with my business if I don't have estate planning in place? Great question, and the answer is, if you were to pass away, your estate needs to be valued, or your assets need to be valued as if you're selling them on the day you pass away. So if you have a business, you're making good income, and you pass away, we have to do a valuation on that, and that valuation will then be treated as if you sold your business on the day you passed away, and there could be big tax consequences on your estate. Then what happens is your estate needs to pay those taxes, and then you can move over the shares based on your will and your wishes at that time. So the problem that I see a lot of times is somebody unexpectedly passes away, they don't have a good plan in place, and the biggest detriment is you end up in a position where you're paying thousands or hundreds of thousands of dollars extra in tax because we didn't have a plan in place of how we're taking that out. How do final tax returns work when someone passes away? That's a great question. So on that end, when somebody passes away, there's a couple different tax returns that can be created. So one is, of course, the final tax return, where we will pick up and say, okay, these assets were disposed of, this is the capital gains, this is how much tax is owed. And then once that happens, is a trust return can be created for that individual. And a trust automatically gets created when you pass away. And what happens on that is that trust is to pick up any income that your estate might earn while you're passed away. Okay, so simple things like I have money sitting in a bank account and pass away today. By the time my affairs are sorted, it could be years. And so during that time period, my estate can be starting to earn interest income, and that interest income, what would happen is I need to be able to report that as taxable at some point. So on that trust, you report that income, and what happens is that income can then get allocated to a beneficiary or to an executor or somebody else on that end there. So thanks again for joining. Thanks for the wave there, Tom. And I'm just going through today. We're talking about estate planning and estate structuring. So any questions, feel free to throw them up there. Next question there. What can I start doing now to prevent large tax on my properties if I die? Great question there. And so the easy answer is sit down with a good accountant, a good lawyer, and start planning that estate component. A big couple items that just off the top of the head that typically can work out well is the potential to move the properties to a corporation that then is owned by the kids, taking away ownership from you now, doing some of the estate freeze and what we call like a possible rollover, where you can still be owed quite a bit of money that you can redeem over time, and then this way it reduces any potential of big tax liabilities upon passing. So getting ahead of it, there are some avenues that do exist. They do get more complicated, of course, so it's great to look at every situation on an individual basis. I believe I might have missed a question there. Are there ways to avoid or minimize the probate process? Great question there. I think on small, simple returns, I think there are ways to avoid that. To be specific, to be honest, I'm not 100% sure on that piece. That would be more on the legal side of questions. But for sure, if whoever's asking that question, feel free to reach out and I can get you connected to the right professionals that can walk you through what that can look like. But typically the process isn't too difficult if the right things are done in advance, and that's having your will in place, having a good plan in place. Another great example I like to give is we've got one client who has managed to basically get rid of all their assets before they even pass away. So the day they pass away, there's nothing left for them, nothing for the estate to worry about, nothing for the family to worry about, because they've managed to already transfer everything that needs to be done. So lots of different options and avenues for sure that are available. Once again, it's Finale with RMI Professional Corporation. We're talking around estate and succession planning, so feel free to ask your questions right now, and if you have other questions, feel free to throw them out as well. We got some T5 slips from my grandma after she passed away. Where do we record these? Final returns have already been filed. This is a good example of where I was saying there could be a trust return that gets established automatically when somebody passes away. And so what happens is the T5 slips for your grandma, they would be under her name. So we would have to do a trust return filing. On that trust return filing, one of two things would happen. The trust itself gets taxed on that income, or a better scenario, because that trust would get taxed at the highest rate, so in Alberta 48% tax, or a better scenario is what we do is we pass that income on to one of the beneficiaries. So you might say, okay, I was the beneficiary of my grandma's estate, so I'm going to take that as income. So we do the trust return, we pick up the income, we say we allocate it to that person, and then that person actually is the one who would pay the taxes on it, but hopefully it's at a lower tax rate than the 48% tax rate that's being paid. So that's one way to be able to at least save some tax dollars on income earned by an estate. So thank you for joining today. I hope these questions gave at least some insight on the importance of why we do some estate planning, why we get ahead of things. And if, as always, if there's any questions around this topic or any topic, feel free to reach out to our firm. It's Irfan Moladina with RMI Professional Corporation, and I hope you all have a great week. Thank you.